In this video, let's have a look at the answers to the test 3 questions. First question on asset turnover. You have a lot of information on the balance sheet right here and on the income statement. In the income statement, you just need the sales revenue, and on the balance sheet side, you need to calculate the total assets out of all of this information. After that, your total sales revenue divided by total assets is going to give you asset turnover, which is in this example 0.669. Next question is on current ratio, which is current assets divided by current liabilities. What you have is the information on the balance sheet over here. You need to calculate which of these parts of the balance sheet make up the current assets, which of these parts of the balance sheet make up the current liabilities. That's basically short-term assets and short-term liabilities. And the ratio of those two is going to give you the current ratio of 1.356. Next question is on debt to equity ratio. Easily enough, as the name suggests, it's a ratio of total debt to total equity. Again, you have information on the balance sheet right here. You need to calculate the total debt, the right side of the balance sheet, divided by the total equity, also on the right side of the balance sheet, to give you the debt to equity ratio of 0.747. The next question is on debt ratio. The debt ratio is the ratio of total debt to total assets. Again, from the information on the balance sheet, you have all the parts of the balance sheet over here. Figure out which parts make up the total debt, which parts make up the total assets, and the ratio is going to give you 0.428. Next question on equity multiplier. That's a ratio of total assets to total equity. In this case, you only have the debt ratio of the company, which is the ratio of debt to total assets. From this information, you need to derive how much equity the company has. So in this case, let me give you a hint. Debt is 35% of total assets. Debt is 35% of total assets. Total assets are only made up of total debt and total equity. So what amount or what percentage of equity would the company have in this case? Once you figure that out, you can figure out the equity multiplier, the ratio of total assets to total equity, which is in this case 1.538. Next question on inventory turnover, which can be calculated as the ratio of cost of goods sold over inventory. You have inventory somewhere here within the list of the details for the balance sheet, and cost of goods sold over here as well. This question is relatively simple, giving you a ratio of just over 3. Quick ratio, remember, is the ratio of current assets minus the inventory over current liabilities. You get all the necessary information here. That's the details of the balance sheet. The ratio is 0.54. And the last question on times interest earned, which is the ratio of EBIT to total interest expense. You have some information on the balance sheet here. Perhaps you might not need this. You have information on the income statement as well. You need to find out how much is the earnings before interest and tax from the income statement data, and have a look at the ratio to the interest expense, giving you 6.273.